Everyone's talking about China and gold. Almost nobody is talking about Russia and India and what they have quietly been building together in the gold market for the last 3 years. That's a problem. Because while the financial media has been focused on Beijing's Treasury dump and Bach Reserve accumulation, two of the world's largest gold producers and consumers have been constructing a bilateral gold trade architecture that bypasses Western financial infrastructure entirely. No dollars, no SWIFT, no London fix, no Western custodians. And if you want to understand where the global gold market is actually heading, this is the story you need to understand, not because it's sensational, because it's structural. And structural changes in how gold moves around the world have more long-term impact on price and availability than any single central bank purchase or price forecast. I'm recording this right now from Denver, and I want you to comment what day and date you're watching from, because I want the timeline to be crystal clear, and this story has layers that take time to fully appreciate. And real quick, if you value this kind of straight shooting breakdown where we connect geopolitical dots that mainstream financial media leaves disconnected, do me a favor. Subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here's the claim making the rounds. Russia and India have a secret gold alliance. They're trading gold outside the Western financial system. They're building infrastructure to bypass the dollar. And the implication is that this accelerates the dollarization and pushes gold prices higher. On the surface, it sounds compelling. Two major powers, gold trading, dollar bypass. But when you slow it down piece by piece, you realize some of it is documented and verifiable, some of it is inferred from trade data and policy statements, and some of it is extrapolated further than the evidence actually supports. That's not the whole story. That's not even half of it. So let me give you the full picture without the hype. So I'm going to break down three things. First, what we actually know about Russia-India gold trade flows, what the data shows, and what the policy statements from both governments confirm. Second, why this particular bilateral relationship matters beyond just two countries trading gold, what it signals about the broader shift in how gold is priced and distributed globally. And third, what this means for you if you're trying to understand where gold goes from here and how you should be positioned. So let's start with what we can verify. Russia is one of the world's largest gold producers. Before Western sanctions, Russian gold flowed through London, through Swiss refiners, through the established Western precious metals supply chain. After sanctions were imposed in 2022, that changed. Russian gold was effectively cut off from Western markets. Western refiners stopped accepting it. Western banks stopped financing it. The London Bullion Market Association suspended two Russian refiners from its accredited list. Overnight, Russia had a gold production problem, not a mining problem, a distribution problem. They were still pulling gold out of the ground. They just couldn't sell it through the channels they'd always used. Enter India. India is one of the world's largest gold consumers. Cultural demand for gold jewelry, gold coins, gold in financial products, it runs deep and it runs consistent regardless of price. India imports hundreds of tons of gold annually. And India, unlike Western countries, did not fully align with Western sanctions against Russia. India maintained diplomatic and trade relationships with Moscow. And the result, according to trade data that has been reported through Indian customs statistics and Russian central bank disclosures, is that Russian gold began flowing to India at significant volumes through bilateral trade arrangements that don't require Western financial intermediaries. Now here's where the clean way to think about it becomes important. This isn't just two countries doing a trade deal. This is a structural rerouting of a significant portion of global gold supply away from the Western-controlled pricing and distribution system. When Russian gold goes through London, it gets priced against the London fix, cleared through Western banks, and financed in dollars. When Russian gold goes directly to India through bilateral arrangements, it bypasses all of that. It gets priced in rupees or in a basket of currencies. It gets cleared through correspondent banking relationships that don't involve New York or London. And it gets financed through mechanisms that don't require dollar liquidity. That's not a marginal change. That's a structural shift in how a meaningful portion of global gold supply is priced and distributed. Now let's talk about the broader architecture, because this bilateral trade is not happening in isolation. It's happening in the context of a broader effort by both Russia and India, along with China and other BRICS-aligned countries, to build what you could call a parallel precious metals ecosystem. Russia has been developing its own gold exchange. India has been expanding the role of gold in its domestic financial system, including gold monetization schemes and gold-backed financial products. Both countries have been increasing their official gold reserves, and both have been vocal in different diplomatic registers about the need for a monetary system that's less dependent on the dollar and on Western financial infrastructure. Here's a question for you. If a significant portion of global gold supply is now being priced and distributed outside the Western system, does that mean the London fix, the benchmark that's been the global gold price reference for over a century, does that start to lose relevance over time? Drop that in the comments, because I genuinely want to know how people are thinking about where price discovery ultimately happens. Now here's the skeptical alternative. Could this be overstated? Could Russia-India gold trade be a niche arrangement that doesn't really challenge the broader Western gold pricing system? Yes, it's possible. The London market is still massively larger than any bilateral arrangement Russia and India have built. Western banks still hold enormous amounts of gold. The dollar is still the primary pricing currency for gold globally. And India, despite its cultural affinity for gold and its diplomatic balancing act with Russia, is also deeply integrated into Western financial systems. It's not going to blow that up for a gold trade deal. That's plausible. Here's how it fails. The argument is not that Russia-India gold trade immediately displaces London. The argument is that it's a piece of a much larger trend. Each time a bilateral arrangement bypasses the Western system, each time a country finds that it can trade gold without dollars and without Western custodians, the system becomes a little less indispensable. And systems that become less indispensable don't collapse overnight. They erode. Slowly. And then faster. And I'm going to say something that might annoy both sides. Russia and India building a gold trade relationship outside Western infrastructure does not mean the Western gold pricing system collapses. It also does not mean that nothing significant is happening. Both of those things can be true simultaneously. The Western system remains dominant, and it is being incrementally challenged. Those two realities can coexist until one day they can't. And the question isn't whether the challenge is happening. It clearly is. The question is whether it reaches a tipping point within a time frame that's relevant to your investment horizon. Now here's where it gets interesting in terms of price implications. If Russian gold is being absorbed by India and other non-Western buyers before it can enter the Western market, that reduces the effective supply available to Western buyers. Not eliminates it. Reduces it. Western demand gets served by Western supply and by whatever portion of non-Western production enters the Western system. If that portion is shrinking, Western buyers are competing for a smaller pool of available gold. That's a supply reduction, and supply reductions, all else equal, are price positive. Now, how significant is this supply reduction? That depends on the volumes. Russia produces roughly 200 to 300 tons of gold annually. If a meaningful portion of that is now flowing to India and other non-Western buyers rather than London, you're talking about a supply reduction to Western markets that's measured in the dozens of tons per year. In a market that trades thousands of tons annually, that's not massive. But it's not zero either. And combined with central bank buying removing gold from the market on the demand side, it contributes to a supply-demand dynamic that supports higher prices. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1, the Russia-India arrangement expands. Other countries observe that bilateral gold trade outside the Western system is feasible and profitable. More of the non-Western gold supply gets routed through non-Western channels. The London market remains dominant but handles a smaller percentage of global physical flows. The price impact is gradual but persistent. Gold grinds higher as the effective Western supply shrinks slowly over years. That's within the set of things this market is capable of doing. Path 2. The geopolitical situation shifts. Sanctions ease. Russia's gold regains access to Western markets. The bilateral arrangement with India becomes less necessary. Some of the rerouted supply flows back into the Western system, adding to supply and temporarily capping price. But India has already developed a taste for direct gold sourcing. The infrastructure is built, and even if Russia's gold becomes available in London again, India keeps buying directly because it's cheaper and faster without intermediaries. The supply rerouting is only partially reversed. That's also plausible. Both worlds can be true in different timelines. I'm not predicting which. I'm saying the direction of the structural change is clear even if the pace is uncertain. Here's what to watch. First, watch Indian gold import data. If India continues importing large volumes and a significant portion is attributable to non-traditional sources, that confirms the Russia-India flow is real and ongoing. Second, watch whether other countries start establishing similar bilateral gold trade arrangements. If the Russia-India model gets replicated, that's confirmation that the parallel ecosystem is building. Third, watch Russian central bank reserve data. If Russia is converting gold production into official reserves rather than selling it into any market, that removes it from available supply entirely, which is the most bullish outcome for price. And fourth, watch BRICS monetary discussions. If gold comes up in the context of settlement mechanisms or reserve assets at official levels, that's a signal that the bilateral trade arrangements are part of a broader monetary strategy, not just a pragmatic workaround to sanctions. Now here's the uncomfortable truth. If the global gold market is fragmenting into Western and non-Western segments, price discovery becomes more complicated. The London fix might not reflect the price that buyers in Delhi, Moscow, or Beijing are actually paying. And if physical gold is trading at different prices in different systems, the paper gold market, which is priced off the London fix, might increasingly diverge from physical reality. That divergence is exactly the kind of thing that, when it becomes large enough and obvious enough, triggers a sharp repricing as the paper market catches up to physical. And historically, when paper and physical diverge significantly, it doesn't resolve slowly, it resolves fast. So what do you actually do with this information? Here's a simple action plan. No drama. Step 1. Understand that the gold story is not just a U.S. inflation hedge or a Fed policy trade anymore. It's a geopolitical trade. It's a monetary system trade. If you're only thinking about gold in terms of interest rates and CPI data, you're missing the bigger picture. Step 2. If you own gold, consider whether you own physical or paper. If the global gold market fragments and price discovery shifts, Physical gold in your possession or in a non-Western custodian is insulated from that fragmentation in a way that a paper claim on gold in a Western bank is not. Step 3. Diversify your gold custody the way you might diversify your investments. Not everything in one form or one location. Some physical, some allocated, some in jurisdictions that reflect the multipolar world that's being built. Step 4. Be patient. Geopolitical structural changes take years to fully manifest in prices. This is not a 3-month trade, it's a multi-year thesis. Size accordingly and let it work. Now, here are my questions for you. Do you think the Russia-India gold arrangement is a temporary workaround or the beginning of a permanent parallel gold market? And if Western and non-Western gold markets eventually price differently, which market do you think will ultimately determine the real price of gold? Drop your answer below, and remember to include what day and date you're watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want to follow up as this geopolitical gold story develops. And if this helped you, share it with someone who thinks gold is just a dollar hedge and hasn't considered the geopolitical dimensions of where it's heading. All right, take care of yourself, and I'll talk to you soon. And just so we're crystal clear, this is educational content. It's my take based on publicly discussed information and my own reasoning, and it's not personal financial advice. I'm not your advisor. I don't know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation, and if you need personal advice, get it from a qualified professional who knows your situation.